And welcome back here to the Domestic Supply Chain Summit. My name is Kevin Hill, here with a special guest, Spencer Tenney. He's the president and CEO of the Tenney Group, and we're going to talk about mergers and acquisitions, M&A activity, both a recap of what we went through in 2022, plus a preview to 2023. So first off, let me welcome you, Spencer, at the summit today.
Thank you, Kevin. It's good to be with you.
Perfect. So we've had a very active season in 2022. It's been pretty active. 2022 or 2021 was active. That's carried into 2022. What are some of the highlights and trends that you picked up on?
Well, I think just for context, I mean, we wrapped up 2021 with pretty much record everything: record activity, record volume, record valuation, and so I think a good bit of that trend continued going into the first half of 2022. And then when we saw, some gyrations in the marketplace with interest rates and freight volatility, you saw a little bit of normalizing within some of those trends that we saw. But still, as far as context, historically, it's a tremendous amount of deal activity is still taking place. And I think that we're going to continue. It's going to be a lot of deals that get done, even in Q4 when it's all said and done. The dust will settle and we'll figure it all out. But it will still be a very, very big year for transaction activity in trucking and logistics for sure.
Yeah, that's one of the surprising how robust it's been since kind of that February, March period where you saw the spot market go below, kind of drop off. It's down 35% from its highs, and inflation, geopolitical risk. You have the stock market, which spent most of the year in the tank, but it didn't really seem to slow down M&A activity in trucking and transportation, which was, kind of odd. You'd think there'd be a slowdown, but it just kept on churning out.
Yeah, and obviously we're trying to make sense of that as that's happening, and I think a lot of that just has to do with the issues that were fundamentally driving M&A pre all that activity were still there. As far as a low margin business, we have the cost of all major expense line items continuing to increase, and so even as you have these kind of things that are inconvenient, be it interest rates and access to capital, it still doesn't change the fact that you still have to run a business and you still have to figure out how to deliver profits for your shareholders. And it's almost like all of the challenges crystallized what were the options and what weren't. And many folks just said like, hey, acquisitions is the only option that we have to offset some of these rising expenses. And so I think that's why you saw, new entrants into this space that have never even gotten into growth through acquisition at all. And I think that some of that has to do with broader trends of kind of one generation phasing out, another one coming in that has a much larger appetite and propensity for growth through acquisitions. But all in all, if you go back, I was talking to one of our clients a while back, and he's like, 7, 8, 9% interest rates. Like, I'm 70 years old. When I got in this space, it was twice that, and we were grateful for it. So, I think context matters, and so, I think that the bigger picture is there's big challenges, and I think that a lot of folks are making big moves to combat that, and that's probably the right thing.
Yeah, and you brought up, change of control in a lot of trucking companies, and a lot of these companies are family businesses. It's getting into the boomer generation, the retirement, changing control over to different family members, or a sell. Is that a trend that's going to keep going 2023, 24, 25, creating a lot more petitional targets than historically there's been in trucking?
It's major. It's outside of trucking too. We're in the middle of the greatest transfer of wealth in the history of humankind. That's really what's happening right now. And that's not hyperbole. So demographics alone are going to drive a lot of this activity. And I think that just the industry specific factors are going to compound that activity just based on the fact that in a low margin industry, you have to increase capabilities in whatever you can. And there's only so many pennies that you can squeeze out of a dollar. So that's why you see a lot of folks really flexing their muscles as it relates to this, and double downing as far as this needs to be a skill that you need to be good at to win the future in logistics.
And it sounds like, well, the activity's been robust all through 2022. How have valuations been? I mean, let's walk through valuations in 2021, and now a year later in 2022, and maybe where you're seeing them go, say mid-year to the back half of 2023.
Yeah, I think for asset light companies that 21 ended with record high, a 7-year record high. I mean, it was continually going up in that period. So we anticipated there was going to be a natural normalization of that, with or without all the stuff that we experienced in 22. On the asset based companies, a little bit more, I wouldn't say volatility, but variation over that same period, just because it's just a little bit different for asset-based, capex, heavy type industries. There's always going to be parameters in which investors can get deals done because of this ongoing capital expense investment that's required to run these companies. So I think for this year, it was interesting because we were still kind of coming off this phenomenon of the equipment value increases that were largely created out of COVID. So some of that we got the benefit of for folks that were doing asset deals, and that they were using these inflated equipment values to increase their own borrowing capacity to help transfer more cash at closing to the seller, which was a beautiful thing, to kind of capitalize it on that way to get the outcome that you wanted to get. And I think that where we're seeing a little bit of, a pulling back on the reins is more on the asset light type scenarios that really, in all fairness, they're still strong, but it got a little bit nuts in, 2021, I would say. And so a healthy normalization there, but all in all, there's never been more excitement for investment or more need for investment in this space. And so it's interesting as you see these transactions, even ones that we've been a part with, as far as these vertically integrated type deals and all different characteristics, whether it be Ashley Furniture, doing the Wilson Logistics Western Division, or even the Super T Transport, which was acquired by Red Bull and their private equity backed Austrian company Berger Logistics. You're starting to see like, wow, we have these huge problems, but the solutions, when it comes down to it, you start seeing the world in a very small lens as far how interconnected everything really is. And so I think that's what we're going to see a lot more of moving in the future. More activity, more creativity on how the deals actually get done, and who the players are as part of them.
Yeah, you mentioned a couple of players there, Ashley Furniture and Red Bull. Do you see more shippers getting into the logistics business, whether that's asset light or, having their private fleet, buying a commercial carrier? We also saw that with USA Truck, and that acquisition as well. So, do you see that as a trend that we'll see more of in of the next 5 years?
I do. I mean, even just in Q3, we heard the announcement of MSC acquiring C&K Trucking. I think that kind of fits that profile. I think that we're going to see more of things like that. I think everything's on the table, Kevin. Whatever advantages or options there are to increase capabilities. And some of this is defensive. It's to protect. I don't think some of this is like to gain more volume. I think it's more about like defensive. We have to protect what we have to potentially be competitive in the future. And so I think that has a lot to do with it. And when you start seeing the market from that lens, then you start understanding like, well, pretty much everybody's in the game.
Yeah, everyone seems to be in the game right now. Certainly, it's crazy out there. Let's start with the asset light. Asset light, the acquirers, they're looking for targets. What are some of the business models they're looking for? Are they looking for niches? Are they looking for customer lists? Are they looking for certain capabilities or technology? Or I'm sure everything, but what's kind of on top of their mind right now?
I think very specific niche expertise is going to be a huge characteristic in 2023 as we move in this. And a good kind of profile for this was the deal that we did with the Keenan Advantage Group and their first foray into brokerage space. And what do they want? They wanted a proven expert, which was American Petrolog. And I think this is an excellent example of kind of predictive about what we're going to see from more folks, that it's not enough just to, hey, I want to have more capabilities, I'm going to buy a brokerage company. They need to provide something unique that's has some insulation from the broader factors that could, elevate risk for the overall transaction. So I think that that's going to be a huge characteristic moving forward as far as on the asset light side. To check that box, I think there's going to be a lot of opportunities.
Yeah, I agree with you 100% on that. There's specific niches, whether it's oil or tanker or flatbed or project based. I think there's a lot of acquirers out there looking for that specialty knowledge. Cross border being another one, where it's easier to buy than build, certainly, and kind of the general brokerages or general type of business entities out there might see a little bit of a hit on their valuation, because they don't have that focus and concentration.
Well, I would characterize that a little bit differently, Kevin. I think that what I think what usually happens is that you get a mirror kind of put up, and you see like what you really are, and like what you really are outside of kind of the last 24 months. That's probably more accurate. And so like when you take away all of the advantages, sometimes that can be misleading for business owners that are specifically trying to grow towards an exit for a specific amount of money. So I think this can actually be really healthy for a lot of asset light companies to help make the appropriate adjustments, because they have more visibility and they see where there's some exposure that might limit valuation down the road.
Yeah, and you kind of gave a little bit of advice, if you're looking to sell your business. What advice do you always give? People in the market, anyone you come across, if they're looking for an exit, kind of what do they need to do to get the house in order for that transaction? Because due diligence is not easy. It's not easy, and it's quite thorough. So what kind of processes, procedures, whatever it may be, to start thinking how long in advance do you really need to start preparing for it?
Well, I mean, I kind of speak out of both sides of my mouth on this. I mean, ultimately, it's worth the most money when the right buyer wants to give you that money right now. Like I think that I think some of this is, I think people kind of make assumptions about like, hey, thank you for the offer, I'm really appreciative, but I probably should do a little bit more homework. When all reality is like they don't care about any of that. They're trying to solve for a specific pain point, and so some of that stuff may not matter at all. Now, you take that scenario out, then my general advice is like, where do most companies lose or miss on opportunities? Is because like they don't present professionally in the first 30 days of evaluation, or even the first like day. And so I think that there's number one, like expect to be courted, expect to receive offers, and have a plan for how you're going to respond to that. And so some people, like, they get overly concerned about confidentiality. Well, fine, let's make a one-page summary, investment highlights that's blind, that shows what your capabilities are, so that you don't have, this mental distraction that people are that have confidential information they don't need to have. And most of the time, you can satisfy a strategic buyer who understands this industry with a one-pager of like, this is what it is. Here's the highlights, and here's what it is. And if they want to go further, then you can sign a non-disclosure agreement and kind of go down that road. But I think being able to have that prepared, and then conditioning your staff to turn financials every month, no later than 15 days after the month closes. I think people don't understand that. That's a huge issue, because once we actually get to due diligence, like you said, time is the greatest killer of all deals. So like if things are changing in your business, what it's really doing, it might be creating new risks. So like, well, this is creating some fuzzy math. We need to wait till that next, how long is it going to get your latest financials? And like, well, we do it quarterly. Well, that's not good enough. Like that could be the one thing that that's going to allow you from, not to be able to get something done. And you'd be surprised of how many pretty decent sized companies do not have that internal cadence in place. And to me, those are just avoid, unforced errors. You do those things, be prepared, make sure you can turn those financials and have your reporting in place, ready to go. And then a lot of good things can happen. And then lastly, which is probably the most important, especially with an industry that has so many multi-generational or founder businesses, it's just you gotta condition your business to be independent of ownership. You have to, systematically delegate responsibility down, because what ends up happening is, if you don't do that, you are voluntarily accepting a discount on your valuation, because you're just injecting more risk into the transfer of ownership. Because if all the accounts, all the relationships, all the suppliers, and all the things hinge on ownership, it's gonna be very difficult to get a buyer comfortable with being able to maintain that level of performance once that owner's no longer there.
Yeah, I mean, you put in a lot of value on yourself if you retain that responsibility and those relationships and the viability of the business going forward, and certainly the growth of the business under new ownership, right? Is if you're still in control of everything, the value is on your shoulders, and you still have to be there and run it to get that valuation to exit, because you can't really just exit. Going into 2023, you talked about strategic buyers a while ago. To give us a breakdown of strategic buyers in 2023, and also, where you see private equity. Do you see private equity taking a larger interest in trucking and transportation logistics, or about the same? What do you think some of the key trends that you're looking out for in 2023 are?
One of the things that we do internally, just to kind of make sure that our assumptions are correct internally, is that we kind of study what are we generating in terms of activity, both in terms of signed non-disclosure agreements and actual offers made by buyer type. And so over the last 4 years, the stats have basically pointed towards about 85% of the offers that are generated for our clients are either strategic or private equity backed strategics. And so I think that's helpful color to understand, like, where are you going to get your money? If you're a seller, for instance, like, where's it going to come from? Well, there's a high probability that it's going to come from someone who has some existing investment, some existent investment in this space. Doesn't mean that private equity folks are not going to get in there. It's just that there's a much higher probability that they might be interested in the asset light portion versus the asset based business model. I think just in general, if they don't already understand this industry, that's a pretty hard sell. So I think that there's going to be continued interest, just because there's so much, I don't know, sizzle right now in terms of the transportation logistics space. I think we're attracting more investment. That's a good thing. But between 22 and 21, we didn't see any deviation from that breakout in terms of when it gets to actually putting pen to paper and making offers. We're not seeing a significant uptick in new players actually stepping out and getting into the game in a meaningful way, beyond historical norms. But I think that is evolving. But I think you're going to see it more so on the asset light, the freight tech side. I think that's where the main sizzle is. But it's a hard sell to get somebody to understand CapEx in this space and to throw down some money and believe that in 5 years they're going to be able to provide a competitive return to the funds that they're responsible to, rather than in some other investment alternative that's a little bit less risky.
I agree. Yeah, private equity groups that are already in the space, certainly in the asset light, using the backed portion of that to roll up, to do additional acquisitions. But before we go here, any other trends for 2023? Something that surprised you in 2022? Kind of your highlight of the market, and that you might have.
I think that what you're going to see, and I think this is kind of a carryover of 2020, 2021, and then, and combine that with some of the volatility around freight over the last 6 months. And I'm hearing this from multiple different places. Experienced acquirers looking to have their growth strategies evolve by just adjusting the profile of the target acquisitions that they're pursuing. And some of the characteristics of those are diversification, to get out of something that they're already doing, because I think there is high sensitivity by doubling down on the same things, but not just for the sake of diversification. They want high insulation, high niche expertise. And then what's interesting is that the profiles for what they would be considering are getting much smaller. I mean, I had a conversation with a very large strategic acquirer who maybe 2 years ago I would have never imagined having that conversation based on the size of the profile. I said, hey, I want you to know, I want Tenney Group to know this is kind of what is priority number one for us. It was just a much smaller profile, and I think that's what we're getting at. It's like, hey, be much more thoughtful about these specific targets that create profitability, that have insulation, that are niche expertise, that do have some propensity or opportunity for growth, but it's just different. And I think that is going to be a huge trend in 2023 because we're not going to stop doing deals. I think what's going to change is just the profile of the deals that actually get done.
Do you think large acquirers are more accepting of smaller acquisitions, much more targeted, much more driven to profitability than maybe making a splash, or maybe not making a splash, but they don't have to be large acquisitions, more targeted, smaller acquisitions?
No, I do think that there will be, obviously there were some huge deals in the last 18 months. So if the question is, do I think there's going to be some transactions that have those characteristics in 23? I do, but not as many. I don't think that there will be as many. I think that they're still going to. I mean, we mentioned like this vertical integration. I think that's probably where you're going to see it. You're going to see something that is a huge splash. It's going to have that type of synergistic upside, much broader strategic play, probably global implications. So I think we'll see them, but we'll see less of them. And I think you'll see exponentially more of the profile that I just mentioned.
Cool. Well, thank you very much, Spencer, for dropping by, joining us here at the North American the Domestic Supply Chain Summit, and look forward to seeing you more in 2023.
All right, look forward to it, Kevin. Thanks for having me.